This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Meta plunges in late trade after a weak revenue forecast and higher spending estimate fueled by bigger investments in AI. Asia's tech majors in focus after those disappointing results. SK Hynix slipping despite forecasting a full recovery in the memory chip market. Plus, the US presses Israel for information about reports of mass graves uncovered in the Gaza Strip. It's just gone 8 a.m. across the Emirates. I'm Bonnie Quinn in Dubai, and let's see how we are shaping up for the Thursday session. A very different picture to yesterday. We have futures pointed very definitively lower. Of course, everything could change in the next few hours, but Meta definitely dominating the narrative today with that massive plunge after hours. Investors, it seems, getting a little bit more discerning on AI, wanting to see what the monetization is going to look like, what the impact on the company's bottom line is going to look like, and how much the company is actually going to be spending in the meantime. We also had a weak five-year auction. We have the 10-year yield now right back down to 464.38, and we are still holding on to gains in Brent crude. Gold coming off the boil, though, as well. We will be watching for more earnings later on to see if the market somehow shifts that narrative. That'll be post-Microsoft and Alphabet. Let's take a look at this chart because it's likely to change once we get through earnings season. But this right now is how we are shaping up when it comes to 4 of the big 7. And you can see it's been a very, very divergent performance since the beginning of the year for Meta, Microsoft, Alphabet and Tesla. But there's a lot going on in Asia as well as the Bank of Japan meeting gets underway and, of course, as the narrative shifts to Asia. Let's get across to Avril Hong in our Singapore studio. Avril.
Yeah, Vonnie, we're seeing that downdraft coming through from Meta, dashing sentiment and stopping Asia stock bounce in its tracks. And even SK Hynix, which reported that beat on operating profit, expecting full recovery, expansion in demand for AI chips, it too is being swept up in that selling pressure. You're seeing the TAIEX, the KOSPI, also lower today. I want to highlight, though, we're seeing again that divergence with Chinese stocks versus the rest of Asia. This is a pattern that's been emerging for another session. But let's take a look at what we're seeing in Japan. As you say, the BOJ meeting is underway, and we're seeing the yen hitting levels we haven't seen against the greenback since June 1990. And amid all this, there are some that think that we could see the finance ministry step in post BOJ, but highlighting here as well what we're seeing among the Japanese stocks. Of course, it's been the chip makers, the automakers that have benefited from the cheap Japanese currency, but today we're seeing how that rally in Japanese stocks is really fragile, selling coming through in Japanese equities as well. Bonnie.
Avril, thanks. We'll check in with you again in a little bit. That's Avril Hong in Singapore. Meta's Mark Zuckerberg then asking investors to stay patient again. The CEO revealing plans to spend billions of dollars more than expected this year in AI development. That's after a disappointing growth forecast. Robert Lee is senior analyst for Bloomberg Intelligence and joins now. So, Robert, Mark Zuckerberg has been wrong before. You only need to think of the VR world, which really hasn't panned out the way he said it would. Is he right this time?
Well, no, that's a very interesting point, and I think Zuckerberg last night did make some pronouncement that Meta is well positioned to be the world's leading AI company, so we'll have to wait and see whether that prediction comes true. But I think last night's result really, is back to reality. I mean, there's been a lot of hype in the world of AI, a lot of very high expectations set by markets with share prices, trading on very, very punchy multiples. But I think the reality, not just for Meta, but AI companies globally at the moment, and I'm referring to the software companies here, is that they are spending tens of billions on CapEx at a time when their monetization models are relatively undeveloped and at an immature stage. So they're not anywhere close to recouping that investment, let alone breaking into profit. And obviously that has implications on their free cash flow, and the Magnificent Seven are obviously one of their key strengths is the huge amount of cash generation that comes out of these companies. So I think it was compared to the euphoria that surrounded the results just 1 quarter ago, I think it was a reminder of the reality of the situation, that the road to profitability for these companies on the AI side is going to be somewhat long and winding.
I mean, mean, the markets have known this for a while, if they were being honest with themselves, right, Robert? Is there some reason to believe that markets may have expected some kind of plan by now from some of these companies?
Well, I think the rational investor, and I've been in a similar view, yes, has taken that. But at the end of the day, markets are driven by sentiment. There's obviously a trading element, and particularly within the tech sector, it's notorious for bubbles and for hype cycles. So, I think we've sort of climbed that wall of the hype cycle. Arguably, we're at the top or coming down the other side now. I think, again, this has no great read across to the long-term opportunity in generative AI and AI as a whole. Again, I think the consensus view, and rightly so, is that there are massive benefits to be gained in the long term. But the reality is, again, these software companies caught in the middle, spending huge amounts on CapEx at a time when they're not really monetizing that. So I think that's a story that will develop through the rest of the year and will clearly impact on sentiment towards these stocks.
Importantly, we get Alphabet and Microsoft, also Intel as well later. Is it possible the narrative will shift after these earnings? What are we expecting?
OK, I'd say three quick things for the internet stocks. First is, again, AI monetization. There are some differences, but that's one area for people to focus on. The second is on their cloud business. Alphabet and Microsoft have far larger, more developed cloud businesses. So we want to see if the AI side of demand is holding up and also the corporate side. So that's something to watch out for. And then finally, shareholder returns. There has been some speculation or talk in the market that Google, or Alphabet, I should say, could perhaps start paying a dividend. So enhanced shareholder returns is another area people are looking for. But don't forget advertising, which is tied to corporate cycle and the economic cycle, makes up a major part of the revenue base of most of these companies. So is that holding up in what is a slowing economic environment? And one quick thing on Intel. Intel, it's all about the foundry. They're looking to diversify away from PCs into foundry. That strategy is not really paid off. We should hear more from them today, but I think it's a big wall and a big challenge for them to overcome, given the global dominance of TSMC.
Shaping up to be a fantastically interesting earnings season. Robert, thank you. Robert Lee, our senior analyst for Bloomberg Intelligence. Let's continue the conversation now with Majid Dola, equity portfolio manager at FAB Global Markets, joining me here in studio in Dubai. I know you've been expecting a pullback. Is this it? A correction even?
Yeah, this is a pullback. This is a nice 7 to 10% across global markets. I mean, it varies from indices to indices. But to your point and to your colleague report, we can see this massive performance over, for example, for Meta, 200% I think last year and 40% this year. So for the stock to drop 25% or 20% or 15%, it just shows that investors baked a lot of good news into these kind of valuations of these stocks. So I believe the drivers of the pullback continue to be intact. We have no certainty, no clarity on interest rate path. We entered the year with 3 cuts. Now some people talking about hike. Geopolitics tension still there. And earnings season is under the way, and we wait to see how companies will report, and the outlook is quite important.
Absolutely, and whether the Fed is going to cut or hike, as you say, next, or how many cuts this year, how have you projected that through the end of 2024?
So, to be honest with you, we were with the consensus that Feds will move fast. However, the nature of the inflation apparently is quite sticky. So, and the economy in the U.S. continue to be resilient. We continue to see yesterday the numbers, the durable good continue to beat, consumer continue to spend. So that put a lid on how fast the Fed will move. We shifted our strategy quite quickly, and we're waiting for the market to digest the news and to reprice this new narrative, or higher for longer.
So if you've been waiting for a pullback, or something more than a pullback, even maybe a correction across the markets, and you've spotted that the market is mispricing perhaps the interest rate outlook, have you been keeping a lot of powder dry?
Absolutely. Absolutely, and we're ready to put money to work, and we're ready to put money into tech stocks. We're ready to put money into growth company across the United States and Europe. But we will be waiting to see when the storm will settle, and that's, I think it's a good opportunity to enter.
Right, because as you point out, we had been trading, at least for tech stocks, at a PE forward ratio of 59 times earnings, and that's down now to something like 34. Is that just the froth taken off, or are we now at reasonable valuations?
I mean, you're talking in aggregate, so it's hard to pinpoint. I mean, for example, Meta is trading at, I think, 25. Tesla is down this year, God knows, I think 40% or something, and it's trading at 50 PE. So it's quite different from one company to another company. The idea is how much these companies will be able to weather the interest rate environment, and not the company themselves, but the consumers and the corporate cycle. Is it going to be resilient? Is it going to be a shallow drop in consumer spending and in corporate spending, and that will reflect obviously on their earnings? I think this is the key rather than the multiples, because current multiples is just a snapshot. The growth trajectory is where we're looking at.
Well, you are looking at AI as a play, but just perhaps not the obvious companies. Can you give us a little bit more detail on where you're looking, and also what geographic area is most attractive now, given that we know the European Central Bank is going to move way before the Fed at this point?
Yeah, but we continue to underweight Europe. We don't think there's much of value there. I mean, you can cherry pick stocks, it depends, but from an overall perspective, Europe continues to be more valued from our perspective. You're right, ECB might cut before Fed, but the reason why they are cutting is quite different from why the Federal Reserve is cutting. So they are in the technical recession. The U.S. economy last quarter posted 3.1 GDP growth. This quarter we expecting around 2.5 GDP growth. So the narrative is different, and the reason and the underneath fundamental for both economies are different. And so you ask about
where you're seeing AI. Most opportunities and across AI as well. I know that you are interested in the AI.
So most opportunities we think in a growth stocks away from tech. We find a lot of companies such as Chipotle, for example. They posted solid results overnight, where they deliver a 20-15% consistent growth. So that's not an AI. I mean, they use a lot of technology, but that's away from your typical companies. When you look at AI, you look at a lot of companies that are getting involved, and we would like to be on the side of companies that receiving the capex, not spending the capex, and I think that's a quite important distinguish. And to the point for your colleague who said that all the spendings will eventually go to certain companies, and we would like to be on that side.
In this region, are you seeing opportunities? Because it feels like there are opportunities everywhere you look, and everyone is trying to get in. But are there, are they real opportunities?
Yes, absolutely. We like UAE on a selective basis, and we like Saudi a lot. I think Saudi stories continue to be resilient, and I think if you will find a lot of growth stocks in Saudi and mid cap in Saudi, then you can deliver quite good performance. I think banks this earnings season in the UAE will continue to do well, backed by high sentiments and interest rate environment that created this fat cash flow for banks, and obviously you have the government spending as well. So a lot of opportunities in the UAE and a lot of opportunities in the Saudis, but you have to do the work.
Well, and to that point, we just got Emirates MBD reporting first quarter operating income that beat estimates, 10.7 billion dirhams, as opposed to the estimate for 10.49. Majid, thank you so much for joining us, particularly in studio this morning. That's Majid Dola, Equity Portfolio Manager at FAB Global Markets. Still ahead, we speak exclusively to the ADIB acting CEO, Mohammed Al-Dalbari, about their outlook for UAE bank margins and loan growth. But first, the U.S. is pressing Israel on reports of mass graves uncovered in 2 hospitals in Gaza. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. The US is pressing Israel to provide information about reports that mass graves have been uncovered at hospital complexes in the Gaza Strip after Israeli military raids. Israel has denied that its forces are responsible. For more, let's bring in Bloomberg's Paul Wallace. This was controversial at the time it happened, or allegedly happened. Paul, what do we know in terms of facts?
So far we're hearing what the UN has come out with based on reports on the ground that mass graves were found with hundreds of people, everything from adult men to women to the elderly as well. There are claims that some of them had their hands tied behind their back. Israel is denying this, saying that these reports are false and this was not to do with them. They're claiming they're not exactly sure what happened, but that some of this was some of these graves existed before this war started, and then it's not to do with them. But it is obviously raising huge concerns, and as we've seen from last night, the US wants answers. One of the things this does do is it once again puts global attention back on Gaza in a big way. Quite a lot of the attention on Gaza has been taken away by the direct attacks we saw this month between Israel and Iran, and I think that's something that the Israeli leadership quite welcomed, because they were getting a lot of support, obviously, from the US and Europeans and others following Iran's drone and missile attack on the country in the middle of this month. This is the type of thing that shifts the focus back to Gaza, and probably in a way that Israel's government is not going to like.
To that point, we've seen a lot more activity in southern Lebanon on the border. Is it possible that that escalates further?
What we saw yesterday did seem to be a bit of an escalation. The Israeli military said it hit around 40 targets in southern Lebanon around one particular village. That's more intense than what they've been doing in recent weeks. The IDF claims that this is a legitimate reaction to fire from Hezbollah coming into Israel, and the Iran-backed group did send missiles further into Israeli territory than at any point since the war in Gaza started in October the 7th. So they're both blaming each other, but the fact remains that tensions are very, very high on Israel's northern border. There wasn't much of a response yesterday from Hezbollah, either in terms of public statements or return fire. So that's something that suggests it's possibly not going to, in and of itself, yesterday's strikes by Israel probably won't trigger a broader escalation.
Well, and then in another theatre, the Houthis are back in action. They claim that they hit a US warship and two commercial vessels yesterday. Yes,
and we're yet to hear from the US, which is usually quite prompt at putting out information when commercial vessels or its own warships have been attacked. Having said that, the Houthis are also usually quite accurate when they claim to have tried to attack ships. Again, it brings back attention to the southern Red Sea and the Gulf of Aden. That part of the shipping world has effectively been cut off for Western vessels really since November, and it doesn't look like that's going to change anytime soon. The Houthis' capabilities have probably been degraded to quite an extent because of US and UK airstrikes on their positions, but nonetheless, they're still able to attack ships. And I think for any Israeli-linked or even just any Western ship, those waters are going to be too dangerous for many more weeks, if not months.
Paul, thank you so much for all the context, everything that is happening in the region. That is Bloomberg's Paul Wallace there. Plenty more still ahead. Do stay with us here on Bloomberg Middle East and Africa. Yeah. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. U.S. Secretary of State Antony Blinken has raised concerns about China's trade and economic practices in a meeting with a Communist Party official in Shanghai. News Desk editor Jill Deesis joins us now in Hong Kong. Jill, Blinken talked about how China should manage ties with the U.S. What exactly did he say?
Well, Vonnie, what Blinken is ultimately trying to accomplish here is just managing this very precarious relationship between the world's two largest economies. He embarked on this trip with the expectation that he'd be focused on issues of industrial overcapacity from China. This is actually part of what the U.S. has been trying to criticize China on for quite some time now. This came up during U.S. Treasury Secretary Janet Yellen's visit just a couple of weeks ago. So this idea of China exporting cheap, low-cost goods to the rest of the world, creating some sort of economic imbalances. That did come up during this meeting, it seems, with this talk about managing this relationship, being wary of trade and everything like that. The other thing that Blinken's expected to bring up on this trip is, the potential for additional U.S. sanctions on China for its support of Russia. So this is also something that did seem to come up during the Yellen visit, this idea that the U.S. could impose additional sanctions on Chinese banks that are seen to have been supporting Russian businesses in its war effort against Ukraine. All of that, I think, is really coloring, this visit from Antony Blinken. We'll see where he ultimately goes with this throughout the rest of the week.
Yeah, a lot on the agenda already, but it is a pretty big meeting. Anything else that we should be aware of beyond those issues?
Yes, Vonnie. So look, he's in Shanghai today. Blinken's in Shanghai today meeting with top Communist Party officials. But I think it's really tomorrow when he heads to Beijing that we could be in for a lot more. He's expected to meet with additional Chinese leaders, possibly Xi Jinping himself. So I think, Vonnie, that's really just underscoring the importance of this meeting from the U.S.'s top diplomat. This is a really critical year for U.S.-China relations. I mean, I think we say that every year, but 2024 is a really important election year for the United States. We've really seen how the Biden administration has ramped up, a lot of pressures on Beijing recently. We've seen a lot of, whether that be in the form of sanctions or trade restrictions, sort of, ways to, it's attempting to combat or contain, Chinese technology advancement. I think all that's going to kind of color the rest of this trip from Blinken as we get through the rest of this week. We'll see if he ultimately does meet with Xi, but at the very least, it does seem like he's going to be bending the air for a lot of top-level Chinese officials.
It sure does feel like those visits by U.S. officials are increasing, at least in the amount of them happening. That is News Desk editor Jill Deesis. Thank you so much. Much appreciated. Let's take a look at how markets are faring now, and a quick look as well at how the Middle East fared yesterday. So we didn't have that meta move impacting, obviously, yesterday's session in the Middle East. What we did have, though, was the Tadawul falling about 1%, which was a pretty big move for the Tadawul, given that it's been small moves and it's down for a third day now. Banks contributing most to that decline, although we did get Emirates MBD, and that might help sentiment on banks in the region. Elsewhere, ADX and DSM were down. You can see the DSM was down about 0.5%. Israel was reopened after the Passover holiday as well. The TA35 up 0.2%. This is Bloomberg. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Meta plunges in late trading after a weak revenue forecast and higher spending estimate, fueled by bigger investments in AI. Asia's tech majors in focus after those disappointing results. SK Hynix slipping despite forecasting a full recovery in the memory chip market. Plus, the U.S. presses Israel for information about reports of mass graves uncovered in the Gaza Strip. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and it is shaping up to be a very different day than it was yesterday post-Meta results. We have futures pointed distinctly lower, particularly NASDAQ futures. Although yesterday we did see the S&P 500 finish flat on the day, and the NASDAQ actually up 0.3%, the NASDAQ 100, that is. This even though it looked like we were going to have a more discerning investor post-earnings, particularly when it comes to AI, and indeed that's what we got. They sent Meta down 19% in the post-market. It's because Meta gave a weak revenue forecast and also, or what was perceived to be a weak revenue forecast, and also said they were going to spend a lot more money on AI. And it seems that investors want to see what the impacts will be on the bottom line now. They want a business plan. They want to see more details. That said, we do have a lot more earnings this week, so this narrative could flip on a dime, as we all know. So let's wait and see. We won't fully make our judgments. We'll reserve judgments. We did have a weaker Treasury auction, though, weaker 5-year auction. 464.38 is where we are now on the 10-year. And we are holding on to those gains for Brent crude. We're above $88 a barrel. This even as gold slides further. So that haven trade is a very interesting one these days. Let me show you this chart because it gives us an idea, relatively speaking, of where we are with some of the Mag 7 companies. This is since the beginning of the year. Performance for Meta, as you can see, where we were up 40% just this year alone. After today's session, not sure that's going to be the case. And then you can see we have been diverging. We do get Microsoft and Alphabet today, so that might change again. But a lot going on in Asia as well. I want to get to Avril Hong in Singapore. She has all of the details. We have the yen panicking a little bit, the Bank of Japan meeting, and lots going on in the chip sector as well, Avril.
Yeah, the chips are down today in the Asia Pacific. No thanks to Meta throwing a spanner in the works of the Asia stock recovery. But it's not just that as to why investors are reluctant to take on risk today. Don't forget we have U.S. data out later today, and that, including on GDP, could go on to shape the path of Fed policy. Indeed, we're seeing those higher yields, and that's part of why we're seeing the move in dollar-yen overnight. Now still sitting above that 155 level, record high in about 3 decades, dollar-yen, levels we haven't seen since June 1990. Now, the pace of depreciation of the Japanese currency seems to be picking up, but as to whether it meets the criteria that's kind of been laid out by the Finance Ministry of rapid moves, that seems to be another question. But let's flip the board, because there are some in the markets who think that the reasons for the Finance Ministry to step in, they're rising. It's not just the weakness against the dollar, it's also against the Aussie and the euro. As to the timing, some see it coming in post-BOJ, simply because we have those PCE numbers coming out from the US late Friday night Asia time, and then into Monday, Japan will be on holiday, so it will be perilous for the Japanese Finance Ministry not to intervene or to do something. So that is what we're seeing across the Asia Pacific today. But as I say, it's risk off, no thanks to Meta. Bonnie.
Avril, thank you so much. Avril Hong there in Singapore. Let's turn to regional bank earnings here now. Abu Dhabi Islamic Bank has reported a 32% year-on-year jump in first quarter profit after tax. That's as the lender's strong growth continues. Mohammed Abdelbari is the bank's acting CEO and joins us now in studio. So congratulations, revenue up 24%, cost-to-income ratio improving, fee income up 40% as well. What happened in the quarter?
Thanks so much, Vonnie. So we're very happy with how we started on the year. And I think we have been on an upward trajectory for the past few quarters. And given the momentum we have seen, particularly in our retail banking side, we do expect the underlying sustainability to continue. And hence, we're reporting this number supported by asset growth, which are now approximately 13% year-on-year at constant currency, supported by deposit growth. So
yeah, consumer deposits up 13%. What's behind the strength of the consumer in these parts of the world?
So there are two things to talk about, Vonnie, is that one is Adib specific and one is the country specific. So Adib has a very huge client base of 1.3 million clients, predominantly of UAE nationals, which provide a very good deposit base for the institution, and we have been growing consistently. It provides us a very solid underlying cost efficiency. Now, from a country perspective, we are seeing growth in the population as well. We are seeing a very positive momentum in the economy, and hence we are capturing that market share as well.
Now, the loan data does suggest that there might be a little bit of pressure on the funding side. side. Can you explain what you're doing to counteract that?
So fantastic. So while given the interest rate environment, which has been up for quite a while, it is expected that the funding costs will go up. Now, for Adib, we are quite focused on ensuring that we have a good funding mix. So we have a good base of current account and saving accounts, which are low-cost funding, but also we have contractual wakalas, which give us sustainability. And we also recently issued a green sukuk, which was the first in that market, giving us a very solid funding base as well.
How do you look at what the Fed is going to do? Because obviously what happens to you, is going to be foretold a little bit by what's being done to interest rates. Do you anticipate that a cutting cycle will even start?
So we started the year expecting probably 4 cuts. Now we're probably down to expectation for 2 cuts if you look at the forward rates. Our view is that the rates will probably stay longer for higher, so we are of that view as well. And for us, we are quite nicely positioned to capture that because our funding structure is in a way where it captures the upside and downside quite nicely. But also on the asset side, our repricing portfolio allows us to capture the upside and protect us from a downside risk as well.
How is that? It sounds like magic.
Yeah, so Adib has a very good diversified asset mix. So we have a mix between fixed rate financing and floating funding. So with a fixed rate, it gives you that air cover in an environment where rates go down. But also when rates go up, you're able to reprice quite quickly. So we are now at I would say, an inflection point where we are capturing the best of both worlds. And even if rate starts to come down, it will actually take a while before it even filters down into our financials as well.
So you're pretty well prepared. The recent floods we were not prepared for. Has it had an impact on your business, on your asset qualities?
I think it's been quite unprecedented, but the response from the government and also from the institution was quite good. We had no impact, at least from the premises, staff well-being, client, which was very important for us. Now we're back to business as usual. And while maybe April will be a bit slower months, given that the accessibility of our clients and the staff was not at its peak, but we expect that May will recover as well.
At Abu Dhabi Bank, you're a little bit removed from regional tensions. But is there an impact on Abu Dhabi Islamic Bank's books?
So we haven't seen any impact yet. In fact, what we usually see is that when some of the geopolitical situation becomes a bit more apparent, we see actually upsides happening in that part of the world. It's almost like a safe haven kind of phenomena. So no impact as such, but we are closely watching the situation. We are very mindful of our surroundings, but so far we have really seen no impact on that.
What about any impact from Egypt and its economy and its difficulties with its currency? And there have been so many headwinds for Egypt, not least the war.
Yeah, but actually in Egypt, it's been quite positive news recently. So with the injections which are happening recently, with the slightly more transparency on the currency versus the dollar, we are seeing a lot of positive momentum happening. We have a big business in Egypt, and while we have been impacted in Q1 from the devaluation which happened, we see on the short term, or I would say medium to long term, slightly more upside to that.
Competition-wise, in the region, banks are doing pretty okay. We just had Emirates NBD also report and beat, and we had Moody's upgrading the outlook for the UAE banks in general. How do you compete?
So we have a very clear strategy, Voni, and we have good market share in the retail bank, and we are very clear on what we are doing. I think we're very well positioned. The banks have done, I think, quite well. But while I don't want to comment on other banks' results, I think we are on a very clear track, and we are growing quarter on quarter, and we will continue to do so as well.
All right, well, congratulations on this quarter, and we will see you next quarter. Thank you for joining. That is Mohammed Abdel Bari, the acting CEO of Abu Dhabi Islamic Bank, joining us. Plenty more still ahead right here on Bloomberg Daybreak Middle East and Africa. Do stay with us. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Meta plunges post-market after a disappointing growth forecast and bigger spending projections on artificial intelligence investments. Meanwhile, Alphabet and Microsoft expected to see AI workloads boost cloud earnings. We get Alphabet a little later on. Let's bring in Stephen Rees, Head of Investment for the Middle East and North Africa at JP Morgan Private Bank. So this pullback that we've seen, this after-hours plunge from Meta, which seems to be dominating things today, is that it? Is AI over?
Well, I like what you've been saying. I think it's still too early to say, and let's remember that stock was up over 40% year to date. And so I think overall the earnings that we've seen so far, there's been a lot more good than bad. And I think what people miss is that this is the first quarter where we're actually going into growth again. So we've had an earnings recession the last 4 quarters, and I think overall we expect a positive momentum in earnings this quarter to continue throughout the year, which we think can drive the equity market higher. Now, I think a lot of the gains have happened, and so this pullback we've seen, 4 or 5%, I think gives investors another chance to step in and add to equities a bit.
Well, it does seem like all the bears have been rolling out of bed the last few days and sort of giving us harsh warnings that we were due for a correction all along and so on. But that's not how you guys see it over at JP Morgan Private Wealth. You see actually upside from here.
Well, yeah, we started the year pretty balanced. We actually saw upside both in equity and fixed income, and I think the world is very much focused on fixed income given yields. And in the multi-asset portfolios, equities have driven the year-to-date returns. I think at these point today, we actually still see upside, obviously, in fixed income, given where rates are. But with equities pulling back, we do think there's another 4 or 5% upside from now until the year end. However, we want to be more focused on different geographies, different sectors. A lot of people talking about the bubble, technology, but if you actually look year to date, technology as a sector is lagging the broader market. And so we do think what we're seeing, this consolidation, is actually healthy because the market's focusing on earnings, free cash flow, and valuation, and that's exactly the sort of stocks that we want to invest in.
So can you narrow that a little bit more down for us? When you say geographies and different sectors of the market, what do you mean?
We like the U.S., but we're now neutral, and we actually see a little bit more upside in Europe. And I know that's a bit controversial, but the valuations look good. We think there's going to be cuts coming from the ECB, and there's a lot of good multinational companies in Europe that we think will benefit from what is still pretty solid global economic growth. Within the U.S., very positive on healthcare. Lots happening in the drug discovery space, and healthcare also offers relatively attractive valuations, trading much cheaper than other sectors. And year to date, the sector actually is underperforming. So I think that's a good combination to outperform.
So is that one specific sector, or is this more of a growth to value pivot trade?
Yeah, I wouldn't say growth to value, because I think there's a lot of good growth in healthcare that's not particularly expensive. And there's also a lot of good growth in technology that's not overvalued. I think everyone's focusing on a couple of AI stocks. But if you look, 4% of U.S. companies are even sort of adopting AI. And so there's a lot more to come in AI. Not just on the enabler side, the companies actually producing AI, but the adopters as well. And so we think about AI, we want to take a much more diversified approach and actually look for companies that will benefit, that actually have good free cash flow and good earnings today, and do it, I would say, in a much more balanced, higher quality way than just buying the high-flying early adopters that might be trading at high multiples.
Julian Emanuel of Evercore ISI makes that point as well, that AI hasn't gone away or anything. It's just that you need to find the revolutionaries.
Yeah, you need to find the revolutions, and you need to take a long-term approach and be very thoughtful about it, and don't just over-diversify in the hot company of today, because as we can see, that can very much change quarter to quarter.
The whole market seems to have been depending on NVIDIA. I do want to ask you, though, what it would take for your bull case to come to pass, because you say for now, you're looking for about a 5% upside from here for the S&P 500, but in the best-case scenario, you're seeing 5,600.
Yeah, that's quite simple. It would just mean that inflation comes down, the Fed actually does cut interest rate this year, perhaps more than 2 times, and geopolitics calm down here in the region. I think that combination could lead to a nice recovery both in equities but also in fixed income as rates would come down in that scenario.
So 60-40 still, or would you shift that a little bit?
60-40 all the way. I mean, we think this is the year to be balanced, and the good news is you can get good upside both in fixed income and in equities, and we haven't had that for some time. And so we do think 60-40 is a good starting point, and that's where we're guiding our clients.
Stephen, all of these geopolitical risks are in the background as well, and it does feel like the market prices them out real fast, but it can price them in real fast as well. Are your clients asking you about this?
Of course, because we're dealing with clients here in the region, and we're trying to, our job is to keep them focused on their goals-based plan. So what do they want out of their portfolio, not just this year, but really for generations to come? And that's hard, and that's what we do every day, is to talk to them and walk them through what are the risks, how the risks change. But you're right, the market really hasn't priced that in, because the market's more focused on global economies, inflation, all of which I think is generally moving in the right direction. But we're watching it very closely. Geopolitics shouldn't keep you out of the markets. You should be aware, you should understand the risks, but you should use the volatility to your advantage and take advantage of that when you get it. And I think we're getting a little bit of that just over the last few weeks with the pullback.
We're just at the beginning of a mammoth earnings season.
Yeah.
What are you looking for in terms of share buybacks, capital return plans?
Yeah, I think strength in the U.S. consumer, I think, is going to be evident. And we saw that just overnight with other companies that reported. I think buybacks will be interesting to see which companies see value in their shares. Free cash flow still looks quite good. And so I think overall, the earnings picture in aggregate is going to look good. Of course, there's going to be some disappointments, less so on the quarters that were reported, but more just, companies are giving a bit more of a cautious outlook.
Yeah,
and
forecast.
when the market was up so much, it needed to be perfect, and that's not happening.
All right, Stephen, we have to leave it there, but thank you so much for coming in and joining us and chatting markets with us. That's Stephen Rees, Head of Investments for the Middle East and North Africa at JP Morgan Private Bank. We're live from the Beijing Auto Show, the first in the Chinese capital since 2020. Next, do stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Just want to bring you some headlines now. Equinor has reported first quarter total revenue of $25.14 billion is a beat. First quarter adjusted operating income coming in at $7.53 billion. Equinor still seeing full year capex at about $13 billion, and it is seeing a total capital distribution of $14 billion for 2024. That includes an extraordinary cash dividend of 35 cents. So all told, positive quarter for Equinor. Now let's head over to Beijing, where the city's auto show has returned for the first time since 2020. Our chief North Asia correspondent, Stephen Engel, joins us from this exciting event. Stephen, what's going on? Tell us.
Hey, Vonnie, there's so many different themes we can touch on. Obviously, we haven't been back here covering this for 4 years, and a lot has changed in the EV space. In completely dominated by Chinese makers and new brands a lot of the world has never heard of, and sub-brands of the existing makers. In fact, of the top 10 cars, EVs that is, that are sold in the first quarter, 9 of them are made by Chinese companies, 6 of them by one particular dominant company, BYD. Tesla is the only foreign automaker on that top 10 EV list. And also, as far as the brands, there's only Volkswagen at number 10 and also Tesla at number 3 among top 10 EV sellers here as overall car sales. So it's a changed landscape, and one with huge geopolitical ramifications for the export of these cars, these EVs that are made in China. We all know European Union is considering tariffs upwards of 20% potentially on the excess capacity, as the politicians in the US and Europe have said, of Chinese EVs going into Europe. And again, it's just about scale and a price war here in China that has helped drive some of those top sellers here in China to a price tag of around $10,000–11,000 US for a new EV. Now, the seller we have behind us is a legacy European automaker that everybody knows, Mercedes. But Germany's, the collective German automakers' market share in the Chinese market in the fourth quarter slipped to its lowest in 6 years. And that's why Mercedes is here in force. BMW is here in force. Volkswagen is here in force. They're trying to figure out how they can regain some of that lost ground from a decade ago, when these players, the German players, the Japanese players, the American car makers, were the top dogs. Not anymore, Vonnie.
Yeah, give us a little more detail on the European presence. You named 3 brands there, Stephen. How many offerings, and are they attracting viewers? Is there excitement about the European offerings?
I have to admit, most of the excitement's about the Chinese car makers, but the Germans are definitely bringing a big contingent of executives and cars. BMW has about 15 models here. They have a joint venture as well that they're promoting with the Chinese car maker Great Wall Motor to build out the next generation of EV mini cars, electric minis. And also, of course, Mercedes has partnerships as well with Denza, which is with BYD, the biggest maker here. They also have another partnership with Geely, another top maker here. So that's what the European car makers are doing. If they can't beat them, join them and have joint ventures. But again, they do want to sell their higher ticket items here, including the ones behind me. They just announced, Mercedes did today, their first, I believe it's the G-Class SUV, electric G-Class SUV for the China market. So they're not doing a mass new model blitz. Mercedes isn't, but they're really trying to show that they're still a relevant player in this market. They are, of course, at the high end, where the Chinese makers are going more affordable and mass market and built on scale. The likes of Mercedes and BMW is still trying to stay sort of at the high end.
Stephen, thank you. Certainly looks like there's a lot of pent-up window shopping at least going on, if not more than that. That's Stephen Engel, our chief North Asia correspondent there at the Beijing Auto Show. So now let's return to those equity futures, because it does look like we are in for a down day this Thursday session after Meta reported. Of course, we are on the cusp of many earnings reports, including Alphabet, which reports later on. We also get Intel. So that may change during the session, but certainly for now, S&P futures are pointed to a drop of 0.6% for the index, which did come in flat yesterday, and Nasdaq 100 futures pointed to a drop of twice that. Treasuries-wise, we saw a weak 5-year auction. There is another auction this week, so we'll see how treasuries react to that, and safe havens, particularly gold, seeing risk off. This is Bloomberg.